Hi there. Welcome to Market Call today on BNN Bloomberg. I'm Paul Bagnall. Thank you for watching. Lorne Steinberg is our guest today. He, of course, is president of Lorne Steinberg Wealth Management. He'll take your questions on global stocks. So get ready to give us a call. In fact, pick up your phone and call us right now. Our number is 1-855-326-6266. The email address is marketcall@bnnbloomberg.ca. We'll get to your questions in the second segment of our show. This is the first segment, and we'll welcome Lorne and get his take on some pretty volatile markets. Great to have you here, Lorne, as always.
Great to be here, especially on an interesting day like today.
Okay, you have managed client money through numerous market downturns. Here we are again. What is similar and what is perhaps unique about this time around?
I find there's always something a little bit unique because no two situations are exactly the same, Paul. The last time we went through a really shocker was, of course, during COVID in March of 2020. The market fell over 30% at a moment in time. The message we sent to clients then was every time we look back on times like these, we always say, darn, I should have been buying those great companies when they're on sale. That is eternally the message. Warren Buffett, buy when there's blood on the streets.
Right.
Completely calm. If you buy great quality, and this is the moment to buy that great quality because it is cheap once again, you will be well served when you look back at your portfolio 5 years from now.
How should investors then think about buying that quality? There's that expression, nobody wants to buy a falling knife. Investors are nervous about buying something today and seeing it down 10% over the next week or so. How do they come to grips with that tension?
Exactly, and I find that all or none is probably the wrong thing to do because it just leads to paralysis. So if an investor had, let us say, $50,000 to spend and doesn't know when to get in, my comment would be just be disciplined, take $10,000 per month or whatever makes you comfortable, but start buying today because if you wait until calmness returns and things improve, you'll have missed the first 25% move.
The investors, you say, should control what they can control. What are some of those things they can control in a very remarkable market environment?
Sure. It's for us, it's easy. Buy the world's best companies, anything from Canadian bank stocks and a whole bunch of other great technology companies. They've all been hammered. This is your opportunity. You can control the quality. Your dividend yields are higher because you're, of course, paying less for these stocks. And great management teams will figure out how to navigate the situation.
Reducing your equity exposure at times like this is a big mistake.
It's always a mistake. You're selling when the world is panicking and you're forgetting Warren Buffett's words. Buy when people are panicked and start selling when everything is rosy. And these are the same great companies. They were the same great companies 10 years from now, 10 years before. They'll be the same great companies 10 years from now. It's you can buy them when they're on sale. Why would you not? You should be loving these times.
That's Lorne Steinberg and his direct advice to investors. This is a time to buy high-quality companies. At the end of this show, of course, he'll give us his 3 top picks at this point in the market. We'll be back right after this for Lorne Steinberg taking your questions on global stocks. There's the contact information once again, 1-855-326-6266 or marketcall@bnnbloomberg.ca. Welcome back. Let's get the questions going to Lorne Steinberg. First comes a question from Roman, our viewer in London, Ontario. Do you have any thoughts on Propel Holdings? I'm holding now, but should I buy more?
So Propel, for those who don't know, is a very fast-growing Canadian fintech lender, making very, very small loans to people who assumedly can't borrow money from banks. The company's been spectacular. The stock has been hammered here. I think probably the fear is, what if we do get a recession? How many of these lenders will not be able to pay back their loans? I mean, risky from that perspective. With other things on sale, we would take a pass on this. But I have to say, management's done a spectacular job building this company very quickly.
Okay. Thanks, Roman. Let's go to Michael. He's our first caller of the show, and he's in Vancouver. Michael, thank you for calling. What's your question?
Thank you so much, Paul. Thank you, Lorne, for taking my call. My question, Lorne, is on Philips. Philips, about 4 years ago, was over $50. Now it's languishing in the low 20s. It's mostly been a range from about 25 to 30 over the last couple of years. I just wonder what your thoughts are. Do you hold it? Do you like it? Or should I be looking elsewhere? I'll hang up, lads. Have yourselves a great day, and thanks so much for taking my call.
Thanks, Michael.
Thank you very much, Michael. So Philips makes medical equipment. If you're unlucky enough to walk into a hospital room, you'll see a bunch of Philips equipment there. They got themselves in trouble a few years ago with a sleep apnea machine and had to make a very large settlement to the FDA. They've been struggling since then. Frankly, they're in this market, Paul, as I said, with everything, most things down. There are, for us, just better places to look, and so we would look elsewhere.
Okay. Thanks, Michael, for that call. Let's stick with the phones. Steve is on the line from Sarnia, Ontario. Steve, thanks for your call.
Hi there. Thank you for taking my call, Lorne. My question is on the TD Bank. Like everything's down today. I think it's around $78 and change. Would you step in to the TD Bank right now? It pays a nice dividend. It was moving up the last few weeks, and then the last 3 days it's tumbled like everything else. So would you be stepping in at this level? Thank you very much.
Thank you, Paul. Yes, we own TD Bank here, and TD Bank's dividend yield is over 5%. The Canadian banks are cheap. With these great dividend yields and low interest rates, why, if not now, when?
Okay, that was Steve in Sarnia, and now we're going to talk to Paul in Toronto. Paul, thank you very much for your call. What is your question to Lorne Steinberg?
Yes. I just like to know about Tesla. Like, it has come down from 280, so it is around 230. So is it going down more, and so what is the good entry point to buy Tesla? And thank you, sir, and have a good day.
Thank you very much for your call. So we do not own Tesla, and our thesis has been somewhat that, you know, over time, every single major car company will have a slew of electric vehicles, and Tesla would not be the only game in town. So, you know, for us, we would look elsewhere. You know, for sure, the brand is probably damaged a bit by everything that's been going on. There are better places to go with less risk, and it's still not a cheap stock, let me say.
I was going to ask you about the brand issue. What you're referring to, I'm sure, is Elon Musk and his very prominent and contentious role in U.S. policy these days. How badly damaged do you think the brand is?
I don't want to make long-term comments, but if he continues along this path, because don't forget, it's not just in the U.S. European sales of Teslas are down sharply. A very strong reaction against him. It seems that just his presence there at the present time is just making this a very difficult story. And then, of course, in China, you have BYD and very cheap electric vehicles pressuring on that side. And a lot of Americans, you know, who voted for Trump do not want to buy electric vehicles in the first place. So you're kind of losing those that did. And, you know, are you going to be able to capture enough on the other side? So sales were down. Better places to be. Okay.
Thanks for that call. Let's go to Otis back in Vancouver. Otis, thank you for your call.
Oh, good afternoon. Your thoughts, Lorne, on Novo Nordisk. Even before the market pullback, it's been having a pretty difficult time here, kind of short-term, long-term. Often the comparison is to Eli Lilly, although Lilly has a little bit more of a diverse lineup, I guess. Your thoughts on, well, maybe both, but would this be an entry point for Novo?
Thank you, Otis. We would hold off. I mean, Novo Nordisk, of course, had the massive run-up with Ozempic, and you know, now there's a whole slew of competitors coming into that category, and every time there's a new release coming out that this drug, you know, leads to 3% more weight loss than that drug, the stock falls again. We prefer a more diversified pharma company than one that is so heavily weighted in this one area.
Okay, that is the first batch of questions in to Lorne Steinberg. He's president at Lorne Steinberg Wealth Management. Global stocks is the focus today, and we'll continue taking your questions to Lorne right after this. Okay, let's go back to the phones. Dominic is in Montreal. Dominic, thank you for calling. What's your question to Lorne Steinberg?
Hello, Paul. Thank you for taking my call. Lorne, I've got a half weight on Fairfax Financial Holdings and Berkshire Hathaway, the B shares. I'm looking for some fundamental analysis from you for the Fairfax Financial Holdings, and if you had a choice between one or the other, would you increase your weighting on Fairfax or would you go with Berkshire? Thank you.
Dominic, thank you very much. So we actually own Fairfax in our Canadian dividend strategy, and we own Berkshire in our global strategy. So why would I have to make a choice? I would happily own both. Both of these can be looked at, insurance-driven companies that are also partly, holding companies. They're just diversified sets of businesses. Prem Watsa, who runs Fairfax, has bought a bunch of restaurant chains and a whole bunch of other things. Berkshire, of course, widely diversified. So on a breakup value, not that these will ever be broken up, we have a net asset value that is quite significantly higher than the current share price, and that for us makes these a buy. Plus, I'd say both would fall into the lower risk category of companies.
Okay. Let's go back to the email inbox. Mehul, Mehul is our email correspondent. I hope I'm pronouncing that name correctly. Mehul writes as follows: Hi, Lorne. What are your thoughts on Cenovus Energy? This is a very beaten down energy stock.
It is a very beaten down energy stock, Paul, partly because the downstream operations, the upgraders and refining and marketing have been extremely weak. One of the things we look at when we look at stocks like this that people partly buy for dividends is what's been the dividend history. The dividend history here is this company has cut its dividend in the past. So we would look elsewhere because, these are not stable dividend payers, but the dividend might look high because the stock price is low. You'd be a little careful.
What's your view of this sector right now with crude oil prices collapsing?
So you have to buy this sector when it looks awful and prices are low. Otherwise, you're buying it at an all-time high. We have minimal exposure, but we do have one stock in the sector that is the opposite of Cenovus because they've never cut their dividend and been a steady dividend increaser. But when things are weak, you really appreciate having a low-cost producer.
Okay, let's go back to the phones. Elliot is in Hamilton, and he's on the line now. Elliot, thank you for your call.
Good afternoon, gentlemen. Live Nation, the, undisputed king of live entertainment, against the backdrop of perhaps a recession on the horizon, how would you rate its prospects going forward? And would you start a position today? Thank you.
We don't own Live Nation. It's not cheap enough for us, but holy cow, this is a monopoly business. So, concert buyers, ticket buyers have no choice. Love the business model. May not love it if I were a purchaser of concert tickets. But if we get a recession, this stock has a long way to fall. So, and I'm not saying we will get a recession, but it's just not cheap enough for us.
I have provided Ticketmaster with a lot of fee money over the years. Thank you, Elliot from Hamilton. Let's go to Brantford, Ontario. Robert is on the line. Hi, Robert.
Good afternoon. I'd like to get your thoughts on the real estate markets, not only globally, but in Canada, the U.S. I think there's tremendous opportunity, anybody who wants to buy real estate right now, because it's like holding a beach ball underwater. When you let that go, it's going to soar. And just a small percentage move in real estate is going to be huge amounts in dollars. So what do you think on the perspective of buying into real estate like now, like homes and apartment buildings? Thank you.
Listen, there's a shortage of housing in Canada for sure. Although in Toronto, for example, there's so many condos coming on stream that we're seeing condo prices soften and even rents soften for the first time. The only REIT that we own is Canadian Apartment Real Estate Investment Trust. A phenomenal, very long-term track record, own great buildings, know how to run them and increase rents over time. And so that would be our pick in the sector. Here
comes that REIT, Cap REIT. What sectors of the real estate market or the REIT market would you avoid?
Well, office buildings are going through this evolution. We don't know how it's going to end. Certainly, malls are going through a worse evolution, and so we're seeing malls getting cut in half, replaced with, condo buildings and apartments. So the steadiest area has always been apartments and there is a shortage of housing in Canada, Paul. So, that's something that we are attracted to rather than trying to make a bet on, what areas will office buildings, are they cheap enough?
Okay. Thanks for that call. Let's go to Walter in Kingston, Ontario. Hi, Walter, and thank you for calling.
Hi. It's on CNQ. Just wondering your thoughts, and would you be a buyer right now? Thank you.
Thank you very much, Walter. So yes, we would be a buyer here. It's the only oil stock we own. We like it because they've never cut their dividends. So they've been able to go through bad times and good times and keep on plowing through. They're also a low-cost producer. CNQ is profitable at $40 oil. So there's a long way for oil prices to fall for CNQ not to make money. And they're a great free cash flow generator, showing a lot of discipline with their capital expenditures. And again, this is conservative, great, wonderful business.
Thanks, Walter, for your question. We will take a break, and when we come back, it'll be time to look at Lorne Steinberg's past picks. Welcome back. It's time now for past picks. We will go back to February the 1st of 2024, so more than a year ago, and we'll check in on some past picks of Lorne Steinberg. One on that day was Compass Group PLC. This one trades in London, as you can see by those pound sterling symbols. Total return over that period of time, 14%. Lorne?
We still own Compass Group. No one knows them, but they're the largest supplier to food courts, hospitals. Half their business is in the U.S., and it's a very fragmented industry. They're by far the largest, and they just keep on making these little niche acquisitions and cutting costs and generating pretty solid profit growth.
Okay, Compass Group, number one, 14% over the past 14 or 15 months or so. Nike is the next one. Recommended at $101.76, now trading at $53, has probably fared very poorly during this period of tariff panic in the markets. Total return here, negative 44%. Lorne?
Sure. Nike, first, the good part about Nike is they're the largest in the sportswear and sports athletic wear, shoes. And listen, they have no debt, so tons of firepower, the industry leader. They made some horrendous mistakes under their prior CEO in terms of distribution. The new person is fixing it. It is a slow fix, let me say. And we're looking really for earnings improvement to start in 2026. But the worst is over. And I mean, this is the global leader.
Those were inventory mistakes. Is that what you're referring to?
Not just inventory. They also changed their distribution. They wanted people to buy more online. And so they damaged relationships with their retailers, like Foot Locker, who are core to this business. And that caused some damage, which is taking a while to unwind.
What about their Chinese exposure? Are they going to be pressured to perhaps bring some manufacturing facilities back to the U.S.?
I have to say, when it comes to things like footwear, clothing, it's impossible because it'll be way too expensive to make it in the U.S. And I don't see any of that happening for these types of companies. Okay.
Starbucks was number 3 on that day, SBUX on the NASDAQ. Here are the numbers there. Recommended at 93.37, now trading at about 76.66. Negative return, 12%.
Listen, Starbucks is a core holding for us, I have to say. They are 6 months into their new CEO. The turnaround is already well underway. We're looking for earnings to stabilize this year and go up 30 to 40% in 2026. But this is a very fast turnaround, best in the business, and no real competitors at this level. Starbucks also makes a lot of money on their float because people put money on their Starbucks app. There's over $2 billion on that app. And, people like me, give them money to use for free, and they buy me a free coffee on my birthday. It's a great business.
That is Lorne Steinberg, and those are his top picks. 1 in positive territory, 2 in negative territory. We'll be back with Lorne after this, president of Lorne Steinberg Wealth Management. He'll resume taking your questions on global stocks, so give us a call. Here's the contact information. We look forward to hearing from you. Okay, let's get back to the phones and, more importantly, back to the questions to Lorne Steinberg on global stocks. Tushar is in Mississauga. Tushar, thank you very much for calling. What's your question? And I hope I'm pronouncing your name correctly. What's your question to Lorne Steinberg?
Good afternoon, gentlemen. I had question on a couple of technology stocks. The first one would be the Canadian software company OpenText. I wanted to check the medium to long-term view on that. And the second one, if possible, would be for the German technology company SAP.
Okay.
So I'll address OpenText first. Listen, OpenText the stock has struggled. This was a growth by acquisition story for a number of years. Earnings flattened out, and the stock has done relatively poorly. We actually like OpenText. It is a very, very cheap technology stock in some good niches. So, for us, we would be a buyer here. And so if you're a patient investor, there's lots of upside in OpenText. They've really made a decision to stop the acquisitions and clean things up and hold on to what makes sense, but there's a lot of earnings power in here.
I was going to make the point that similar to Nike, perhaps in broad strokes, this is a company that's made some mistakes in the past, correct? With excessive acquisitions and maybe not the greatest acquisitions?
Exactly.
Right.
I think it was, they had so much cash flow, they were buying things not necessarily at the great price and not necessarily a good enough fit for the company. And management is very, very focused on streamlining what they have. And there's not a lot to fix there. It's more a case of if they should sell something, sell it and focus on what's making money.
Okay, SAP, do you have any thoughts on SAP?
The only thoughts I have is, listen, SAP has been it's a core part of many companies' business, the guts of a company. That being said, in a market like this where tech stocks have fallen off, we think there's so many better opportunities, we'd look elsewhere.
Okay. I can tell you, Tushar, that analysts, Wall Street analysts are positive on SAP. 15 say buy, 3 say hold. Thanks, Tushar, for your call. Let's go to Vancouver once again. Debbie's on the line. Hi, Debbie.
Hi, good morning. I would just like your thoughts, please, on Topaz, TPZ. I'm thinking of purchasing it, and I will hang up and listen. Thank you very much.
That's not the stock we were expecting. I'm not sure you've got a lot to say on Topaz, do you?
I can't make a comment on Topaz, let me say.
Okay.
We don't own it, and I haven't looked at it in a long time.
Okay. Thanks, Debbie. We were expecting TC Energy there, so we'll just move on. Robert is in St. Catharines, and he's on the line right now. Robert, thanks a lot for your call.
Hi, no, thanks for the time. I've been looking at auto stocks for the last little bit, and the BYD Company Limited. I find is a very big electronic car manufacturer that outside of North America is doing very well. I was just thinking of your thoughts on that. It's down 8% today, but it's had higher price points. Yeah, just to know your input.
Okay, BYD, not to be confused with Boyd Group, which has the ticker symbol BYD. This one is it manufactures automotive products and is based in China. Go ahead.
Sure. So first of all, we would avoid Chinese stocks, and only because if they don't have the rule of law there, the Chinese government has gotten involved in a whole bunch of different things and upended things like the large technology companies and the like. So better places to look. I have to say, as a car company, BYD is changing the auto industry. They've come with a very cheap electric car. It's taken China by storm. It'll compete in Europe. I don't know that it'll ever be sold in North America anytime soon. But really it's buyer beware when looking at stocks in China.
Okay, thanks for your call on BYD. Let's go to Bill in Bowmanville, Ontario. Bill, thank you for your call.
Thank you for taking my call. Could I have Lorne's opinion on Apple? Is it a buy now? I'd like to hear his thoughts. Thank you.
Thank you.
Thank you, Bill. We don't own Apple at the present time. I have to say, and it has been too expensive for us, but with the drop in the stock price, we're actually looking at Apple. Nothing's really changed with Apple. The one issue with Apple is China's reaction to the tariffs in the U.S. and are they going to put pressure on people they've already put pressure on the government employees not to buy Apple phones. And this is the one negative I see with Apple. as opposed to consumer sentiment, which will be a temporary situation.
Okay, Apple, 34 analysts say buy, 18 say hold. So Wall Street is somewhat split on this stock. Let's go to Sal in Toronto. Sal, thank you for your call.
Hi there, thank you. My question is on Louis Vuitton, LVMH. I was wondering, I know that the luxury sector has taken a big hit due to tariffs, so I was wondering if you think this is a good time to jump in or to wait until things clear up a little bit more on the tariff picture. Thanks so much.
Spectacular company, and it's not just Louis Vuitton, of course, it's champagne and a whole bunch of other premium products. The sector had already taken a hit because of China. So China's slowdown caused these stocks to drop substantially already. For us, we're holding off because if we do get a recession, then this will get really cheap. We've seen that before. This is quite a cyclical type of company, so we would hold off, but it's certainly best in class.
Okay, thanks for the question on Louis Vuitton, one of the flagships in the luxury sector. Let's go to an email from our email inbox. Kevin has written as follows: I'm interested to know what you think of Linamar, the Canadian auto parts maker and a stock that has suffered mightily through all this angst about tariffs in the United States.
So we've preferred Magna, which of course is also a major auto parts, much larger manufacturer. But when I looked at the chart, Paul, over the last 10 years, these two companies basically put the chart on top of each other. It looks exactly the same. Mm-hmm. So in some ways, I would say pick your poison. We prefer Magna because it's far more integrated into the major auto companies. They can't live without Magna at all. And that's the reason. But the stock price has performed exactly the same.
And these stocks look to be very tariff related. Is this the right time to buy when sentiment is the worst? Is it time to avoid them? What do you think?
I would say, again, in a diversified portfolio, you want to own things that are companies that are profitable, that will stay profitable. Magna makes money every year, sometimes less or sometimes more. Of course, you'd rather buy them when things look awful.
Okay. That is Lorne's take on Linamar. We'll be back with Lorne Steinberg right after this. He's president at Lorne Steinberg Wealth Management. He'll continue taking your questions for one more block on global stocks after this. Welcome back. Let's get one more round of questions into Lorne Steinberg. It's been a great show so far. Lots of questions, lots of great insight from Lorne. Gulam is our next caller. Gulam's in Toronto. Gulam, thanks for your call.
Hi, good afternoon to you both. My question is I own some Bell Canada, and I was thinking of, as you know, the price has really fallen. I was thinking of putting some more money into Would you buy more Bell Canada at the moment to average my costs down, or do you like TELUS? I'd appreciate your opinion. Thank you.
Thank you very much, Gulam. In fact, we like both, and I have to say, even if you look at the price activity over the last few days, the telcos have actually held up. One of those sectors is actually holding up rather well in this market. For us, this sector is bottomed out. Anticipate with your BCE a dividend cut. For us, if the dividend's cut 50%, that will be fine. That will free up money to reduce debt and also possibly to buy back some stock over time. But BCE is still throwing off significant free cash flow. It's just a question of the allocation. TELUS has done better growth. They've invested in other things as well, which has diversified the business somewhat, so they've held up better. Also, these two companies, Paul, even with BC cutting their dividend in half, even if TELUS made a 25% cut, high dividend yields, tremendous free cash flow, lots of opportunity going forward to buy back stock. The worst is over for the Canadian telco sector. And a phenomenal opportunity. You're picking up great yield as well.
There's increasing talk about a BCE dividend cut. You don't think the share price the bottom is going to fall out of the share price again if that gets announced, do you?
I think, if anything, it will be a positive. Right. I have to say the investment community wants them to cut the dividend, wants them to reduce debt and take a better capital allocation strategy. As a shareholder, we would prefer to see our dividend cut by 50% and the company embark on a different road.
Okay, and what do you think of the acquisition that the company made in the States? Somewhat contentious, not universally popular.
That's right. They're making a big bet at the price they paid. they took money from, selling the assets they sold to Rogers. So, Maple Leaf Sports Entertainment, that they weren't earning anything significant on that. So they'll earn something on this. Time will tell if they overpaid or not. But, it's just honestly too early to say. Hopefully management and the board looked at things carefully and knows what they're doing.
Okay, that acquisition is Ziply. It's in the Pacific Northwest of the U.S., and it is a fiber internet provider. BCE is the parent of this television channel through its Bell Media division. Let's go to Ash. Ash is in Stratford, Ontario. It's an email from Ash. Usually I buy 1 to 2 year treasuries, Canada or U.S., for safety and hold them until maturity. Are there any scenarios where selling these bonds early would be recommended?
Well, my comment is if you want to have a fixed income asset allocation and that's the reason you bought them, then you should hold them because that's who you are. If you have them and say, would there be a better opportunity? If the stock market really takes a massive beating further from here, that could be a source of cash to deploy into equities that will give you much higher yields, even if your share prices, wallow around in the wilderness for a while.
Okay, thanks for the question, Ash. Let's go to Gil. Back to the phones. Gil is in Brampton. Hi, Gil.
Hi, good morning, gentlemen. My call is with regards to NVIDIA. I have a small position, and I'm wondering if this would be a good time to add on to average out my price. And if I can have your opinion, I'll just hang up and listen to your comments. Thank you.
Gil, thank you very much for the call. So our pick in the sector is actually Taiwan Semiconductor. Taiwan Semiconductor makes the chips for NVIDIA and a whole slew of other businesses as well. So it's far more broadly diversified. It's also selling at a much cheaper valuation. Yes, NVIDIA has fallen, but it is not a cheap stock, and factored into the share price is a huge growth expectation. So our recommendation is, just because a high flyer, the shares have fallen, doesn't necessarily make it cheap. Whereas Taiwan Semi, we look at a much more clearer growth path going forward over the next few years, and because a lot of their capacity will be contracted by companies like NVIDIA.
Okay, thanks for that question. Let's go to Ray in Pickering, Ontario. Ray, thank you for your call.
Yeah, hi guys. Good morning, and I was just wondering, with all the volatility in the last 3 days, if this would be a good time to get in on a best-in-class Canadian bank. And I would like to know if that might be, in our guest's opinion, Royal Bank. If I'll hang up and listen to your answer. Thank you.
Thank you.
Thank you very much, Ray. So, we like the big 5 Canadian banks. They're all a little bit different, but they're in some ways very much the same because they all have wealth management, retail, and commercial banking in Canada. So listen, Royal Bank is among the cream of the crop, incredibly well overcapitalized, in fact, rock solid dividend yield, probably around 4% at this share price, Paul. There's nothing not to like about Royal Bank, let me say. This is just, it's the oligopoly of Canadian banks, and so here we are, take your pick, but Royal is the best performer, largest in wealth management, which is certainly a big growth area, very disciplined over the years, steady dividend growth, definitely a buy here.
Okay, and Bay Street agrees, Ray. 16 analysts say buy, 2 say hold, only 1 says sell. Let's move on to Sandir in Woodbridge, Ontario. Sandir, thank you for your call.
Thank you for taking my call. I need your opinion on Shopify. Where do you see the stock in the next 1 to 2 years?
Thank you very much, Santir. So we are not ready to buy Shopify. Again, this is a stock that has really suffered a lot over the last little while, but it remains not a cheap stock. There's a lot of growth still built into the share price. So, even at the current share price, this is a relatively expensive stock, and we would look elsewhere. We would prefer an Amazon, quite frankly.
Mm-hmm. What about Celestica? Another, probably the other most prominent tech stock has also been hammered, I think worse so than Shopify recently.
Sure, and Celestica, we're actually looking at Celestica, Paul. So Celestica is an IT outsourcing provider, so a very different business from Shopify. But that business, there will be steady demand, and many companies just absolutely depend on Celestica, and that's the advantage they have, whereas consumers, if there's a recession, may stop buying or buy less. So we're actually looking at Celestica as a possibility.
And why would you specifically prefer Amazon to Shopify?
Far more broadly diversified, way more broadly diversified, plus the cloud business for Amazon is a massive business. They're one of the 2 largest cloud players in the world, and basically every company of any size is now forced, because of cyber, to use cloud services, and so your choice is Microsoft's Azure or AWS from Amazon. And that is a huge part of the growth story of Amazon.
And there's Amazon's share price. We began our conversation, Lorne, with you saying today that this is a good time to buy great companies much more cheaply than they were just a short time ago. That looks like it applies to Amazon. If we bring back that 1-year look on Amazon, I think viewers will see it more vividly. It has come down in a big way, in the past few trading sessions, but also since the beginning portion of February.
Sure, and also, of course, fears of recession hitting every type of retailer, including e-tailers, and so that's having an impact on companies like Amazon and Shopify as well as everyone else in the sector. And this is why, as bad as things look, if things get worse, the Fed will cut interest rates, always a positive, and we may see possibly some changes to tariff strategy.
Okay. That, unfortunately, is all the time we have for viewer calls and questions today. Thank you to everybody who put a call in. If you didn't get through, please try again tomorrow or on a subsequent edition of Market Call. We will have Lorne Steinberg's top picks right after this. Please join us tomorrow on Market Call. Brett Gerard will be our guest. He's Chief Financial Officer and Portfolio Manager at Liberty International Investment Management. He'll take your questions on global stocks. And if you miss an episode of Market Call, check out our daily podcast. You can find it on iHeartRadio and other podcasting platforms. You can also watch full episodes on our YouTube channel. Welcome back. It's time now for Lorne Steinberg's top picks. Alphabet is the first top pick today, not in terms of preference, but in terms of sequence. Ticker symbol GOOGL on the NASDAQ. Lorne.
I've never recommended Alphabet before, but I have to say at the current share price, Paul, this is just incredible value. This is a $350 billion revenue company growing at over 10% per year. Everybody knows, search, Chrome, Maps, YouTube. It's just a growth monster, and R&D spend is almost $50 billion per year. So all of these companies, including Alphabet, are their own venture capital companies. They're investing so much money in AI and things that we'll be talking about 10 years from now. At 18 times 1 year's earnings, you're not buying this for the dividend, although they just started paying a tiny dividend of 0.5%. We look at a stock like this as being a double over the next 5 years, easily from here.
And is advertising revenue growth still a big part of the Alphabet story?
Advertising is still about 80% of the story, and that's not going to go away anytime soon because advertisers are so focused on trying to hit, those core key markets that get shrunk down, those specialty niches that Alphabet delivers so well.
Alphabet is number one. JP Morgan Chase is number two. JPM on the New York Stock Exchange, often considered the flagship or certainly one of the flagship U.S. financials.
For us, they're the flagship U.S. bank. Jamie Dimon has done a spectacular job going back over time. This is one of the few U.S. banks that did not have to raise capital during the financial crisis. Pristine risk controls, Paul. And the stock is trading at 13 times earnings, about a 2.7% dividend yield. They're number one or number two in basically all of their major businesses. They're still growing. They're still gaining market share. a core holding in any portfolio. And this is the time where you can really buy the best companies. You don't have to go down the food chain.
And again, let's take a one-year look, bring back that one-year look on JP Morgan. You'll see just how dramatically it has tumbled quite recently on the news that is really taking all stocks down substantially. Look at the plunge in the past couple of weeks from about 245, it looks, to 210 today. JP Morgan, number 2 today. Johnson & Johnson is number 3. J&J, the drug company.
Sure. So J&J spun off its consumer products division a couple of years ago. It's now pharma and medical technology, which is really medical devices. First of all, one of the 2 AAA rated companies in the U.S., Microsoft being the other. So pristine balance sheet forever. 62 years of consecutive dividend increases, and that's coming from their free cash flow. It's certainly not coming from borrowing money. The company is trading at a crazy cheap valuation of 14 to 15 times earnings, 3.2% dividend yield. What makes it partly cheap is the fact the ongoing talc litigation.
Right.
A judge in Texas recently turned down their effort to settle this for $7 billion. J&J issued a press release last week, Paul, and I've never seen a press release like this from a drug company. They said the evidence that was presented during the trial makes it very clear that all of these lawsuits on talc are based on completely fake, false science, and that they are instead going to choose, if the other side won't settle, they're going to choose to litigate all of the individual cases.
Wow.
And that's what Merck did back in the day.
Right.
When they had their litigation. J&J is basically fed up. I suspect this is a ploy because the law firms who are putting money into this, and sovereign wealth funds have been backing law firms on this, is they're just going to pressure to get a settlement here, even if they have to pay an extra couple of $2 billion. I suspect by the end of the year, this will be over.
Is that type of headline stock market friendly, or does that suggest this is going to grind on for another long period of time?
I wouldn't say it's stock market friendly because investors don't like buying a drug company where there's still this outstanding litigation. But I have to say that press release basically calling everybody a liar in the courtroom, I have never seen before, and they've made it clear like they're done. And, you know, if you're a law firm who's waiting to get a settlement out of this, that will probably put more pressure on you.
Okay. Lorne, I want to thank you once again for joining us today.
Thank you so much for having me, Paul.
Lorne Steinberg was our guest. Always great to have him and his expertise here on Market Call. Let's take a quick look at markets before we turn things over to our partners at Bloomberg Television. There is the North American picture with the S&P TSX Composite Index down by 2.5%. I'll give you a snapshot of the most influential decliners in Toronto. Enbridge is number 1. Enbridge is down by 4.3%. That's taking 40 points off the index, followed by Royal Bank of Canada, a stock we talked about today. Canadian Natural Resources, ditto. TD Bank, we talked about that one as well, and CP Rail. Those are the top 5 most influential decliners. So it's broadly based. Some of the biggest names in the Canadian stock market are leading the TSX down today. The S&P 500 in the U.S. is down by 1.6%, and the NASDAQ Composite is down by 1.5%. Let's move on to the price of gold. We'll check in on gold to see if it's still in positive territory. It is not. It's down, but down slightly. It is, for the most part, has held on to its value through this period of market turmoil. Let's go to crude oil. There's all kinds of worry in the crude oil market, not only from the tariff situation and the prospects for a slowing global economy, which would undercut growth, but OPEC Plus has counterintuitively perhaps decided to accelerate production increases to production quotas. Now, we spoke with Halima Croft. She's an expert at RBC on the geopolitics of oil, and she thinks OPEC Plus is sending a message here to Russia and some of its affiliated producers basically on market share, cautioning them to restrain their own production and don't get into a production war with OPEC. That's her take on that situation. Let's go to the Canadian dollar and see how it's faring right now. There is the Canadian dollar essentially at break even. The path of travel on the loonie recently has been up as the U.S. dollar has sagged in a big, big way on the tariff news and the expectations that the Fed may have to cut rates earlier than earlier believed. As early as next month in the minds of some market participants, and certainly in June if a May cut doesn't happen. Those are much earlier cuts than the market earlier had thought before that were coming in 2025. That's a weakness for the U.S. dollar, and as a result, the Canadian dollar has rallied. Let's finish with a look at Bitcoin on this day when most asset classes are down. There's Bitcoin. It's down by 1.5 percentage points to just over $77,000 per coin. Thank you so much for watching Market Call. We'll see you here next time with Brett Gerard, our guest. In the meantime, our partners with Bloomberg Television will take it from here.